Hello everybody, my name is Yogesh Patil. Welcome to this video. Today we are going to discuss about commercial real estate. Commercial real estate is any property that is non-residential that is used for businesses. Most of my students, they know about residential real estate and now they want to move on to the commercial real estate. So today we'll discuss about the two asset class, and there are multiple assets class in commercial real estate. It can be retail, it can be multi-family apartment complexes, hotels, industrial facilities, manufacturing facilities, or even land for that matter. And then there are many others. And today we are going to discuss about the two. Many of the people, they know more about residential real estate and they want to transition to the commercial real estate, and they usually start with multi-family or apartment complexes. So multifamily is traditionally viewed as a very safe or one of the safest asset class in commercial real estate. And the reasons are very obvious. Many people know about residential houses, they buy houses. I bought more than 60 houses before I bought my first apartment complex. I wanted to buy a bigger 200 plus unit apartment complex. I was going around in the neighborhood looking for what kind of properties are around in the neighborhood, how is the neighborhood, and then I came to one of the property. The owner was right there. I met with him. I was asking about like how is the area, how are the rents, and how are the, all those kind of things. We became good friends. Sat on the table that same day, and we discussed for a couple of hours. And he said, "Hey, if you're gonna buy 200 units, why don't you buy this 38 unit apartment complex?" And that's how I transitioned. And I felt confident that I had more than 50, 60 houses at that time, and going into apartment complex as an investment in commercial real estate sounded like a very good transition to get into. And that's how a lot of people think about it. But you don't have to get into residential, or you don't have to graduate from residential real estate to get into commercial or apartment complexes. Because as an investor or landlord of the commercial property or an apartment complex, as an owner, you know that everybody needs a place to stay, and you can increase the value of the property by just increasing the rent or increasing the net operating income. Net operating income is nothing but the gross revenue minus the expenses. So whatever is your net operating income, that defines the value of the commercial real estate, especially apartment complexes. You can increase that by increasing the net operating income. If the occupancy goes down for whatever reason, like recently we had an apartment complex and there was some floods and all that. In the other areas our property didn't get flooded, so a lot of people moved into this property because it didn't get flooded in Houston. So you can always increase the occupancy, and you can, for some reason if your occupancy goes down, you have the control to increase the occupancy by lowering the rents or offering some concessions or discounts to the tenants. You can do good marketing. We also have a social media agency where we help a lot of commercial real estate, especially apartment owners, to increase the occupancy of their apartment complex. What are the drivers of apartment complex or any multifamily investment property? Basically the rents and the income. That is what defines the value of the property. What we call it as a forced appreciation. You don't have to depend on the market analysis. You don't have to depend on, like in residential properties, you have to depend on the CMA. If the whole neighborhood goes up, your values might go up. If the whole neighborhood goes down for whatever reasons like flood or what, then your property value goes down as well. And I did suffer that. I bought few houses in Ireland, Bel Air area, and it flooded 3 times consecutively in the recent past, and the values have gone down. Luckily, I bought it at a low price, and so I'm good. But I definitely suffered a loss because of the values went down because of the flood. But again, the flood insurance paid for it. So I digress. But in commercial real estate, especially apartment complex, you can increase the rent You can decrease the expenses to a certain level, but there are many other ways where you can increase the total income from your property, and we'll get into that in some other video. I just wanted to cover. Then there are some expenses that you have to consider, or those are the factors that you have to consider, especially like tax, insurance. The taxes usually go up, but you can fight it in the county. You have to have good insurance on the property. If it is in the flood zone, you take the flood insurance as well. Then, of course, the repairs, maintenances, utilities, payroll, property management, all these are part of the expenses in any apartment complex. Then you have to also consider what is the marketing that you do. What are the concessions you give? What is the vacancy factor? Vacancy factor is one of the biggest factors in apartment complexes or any commercial property for that matter. There are two types of vacancy factors. One is actual vacancy. We also call it as a physical vacancy. Basically, if there are 50 units and let's say 5 units or 10 units are unoccupied, for whatever reason. So the physical vacancy would be 20%. 10 units are vacant for a year, then it's 20% vacancy. But let's say those 10 units are only vacant for 6 months. Then the vacancy factor, actual physical vacancy drops to 10% because they're kind of 5 units for a year or 10 units for 6 months. So you can determine the physical vacancy based on that. But there is another vacancy called economic vacancy. Economic vacancy, there are many other factors that you have to consider, like the actual physical vacancy plus the free rents you have to give. Lot of land, I don't recommend that, but lot of landlords give 1 month free, 2 months free, $99 move in, and things like that. So you have to consider that into consideration. Then there are different discounts you provide or different concessions that you give for maybe extending your lease or to get the tenants in. Then there is some bad debt. No matter what, there will be always some time when people cannot pay. They have their genuine reasons. Some people just don't want to pay. But if you do proper tenant qualifications, then you won't have those problems. But in apartment complex, you'll always have bad debt. Then there is turnover time. When the tenants move out, you have to fix it up, and your team will do a good job of that. But whatever is the turnover time, you still have to consider that. Then there are some model units that you do just to show those properties. If you have a bigger property, then you might have 2-3 units that are just sitting vacant because they are model units. If your occupancy is high and vacancy is low, then you don't need those. But that needs to be considered in calculating the economic vacancy of any apartment complex. So those are some of the factors that we have to consider in commercial real estate, especially for apartments. Now let's move on to the retail properties. Retail properties, there is very high competition in multifamily because a lot of people, when they want to transition to commercial real estate, they go to multifamily or apartment complexes. But the retail properties is one of my favorite now, especially because whatever the multifamily used to be a few years back, now the retail industry is at that point. You can get a lot of retail properties at a discount price. And if you know what kind of retail properties are out there, then you can focus on them. There are many of those, and you can find very good deals right now. Again, depends on where you want to start, but I just want to give you different types, and then in the end I'll tell you which is my favorite retail property that I'm focusing on and working on right now. So the different properties in retail is like grocery anchors. Like for example, you have HEBs, Kroger's, and those kind of tenants where they usually occupy the whole building, or there might be some other smaller tenants that you might have depending on that. Um, that's a little bit bigger game, and a lot of REITs are into that. But it's a very steady and stable income for the commercial real estate. There might be some supermarkets or department stores that can be a good anchor tenant as well. Then there are national tenant anchors. Any national tenant that is out there, it can be a discount tire, it can be HEB. Those are usually the national chains that are available everywhere. And there are some that are trending down, and there are some that are really growing. And as you know, because of Amazon, there are many retail industries or companies that are going down, but at the same time there are many that are coming up. So as long as you know the trend, and if you want to learn more about the trends, I can help you with that. Let's move on. There are some unanchored retail that are not national tenants, but they are still good tenants. Examples of those are like any convenience store that usually stays local, and they stay for a long time. Then there are local tenant retails like any restaurants. The restaurants can be national or it can be local restaurants as well. So those are some of them. Then again, there are many franchises that you can look into, like Bath and Beyond, any nail salon or Subway or things like that, where they take some small portion of your retail, like a building that you own, or hopefully. And then there are some regional malls. Nowadays, there are many retail shops that are going down, and there are regional malls that are coming in. So that is also very interesting. Then there are smaller mom and pop stores that you can look into. There are specialty stores, like there is a furniture store or apparel store or things like that. There are variety stores like a convenience store you can have, where they sell many things in one particular shop. It can be deep and narrow, or it can be wide and shallow. So there are different types of tenants that are available. But my most favorite right now is a single tenant building, and they are very easy to find. You can, if you look around, you'll always find a single building that is sitting vacant or is for lease. And those are the most profitable and the very easy ones to get into commercial real estate. And then those give you the maximum profits in a very small amount of time, if you will, if you know how to get the proper tenants. Some of the examples of tenants are like Starbucks, Taco Bell, or it can be bank, or it can also be like a dollar store, or any facility, or any tenant that you can think of that occupies the whole building as such. What are the drivers in retail? These are some of the drivers, like tenant credit. Tenant credit is the credit that you get with, especially with the national tenant or any bigger anchor tenant that you can have. The better credit you have, like for example, McDonald's or Burger King or even Subway for that matter, or the bigger companies like Dollars General, or any big restaurants that are national tenants, can have a very good tenant credit. The better tenant credit you have, the better the value of the retail property. The banks like that. You can show the bank that, hey, here is the lease with McDonald's or Subway, and that gives you a better terms with financing, if you will. Then there are some co-tenants like Target. Target has a lot of other smaller tenants. If you have a store, and then there are some other smaller stores or tenants that you can get. But sometimes if Target kind of closes the store, then these other tenants suffer a lot as well. These smaller tenants, they go next to Target or Walmart or Sam's Club or Kroger for that matter, just because these bigger tenants, they pull in a lot of traffic, and because of that, these other smaller tenants, they get a lot of business just because of the bigger anchor tenant. And we have some land or some properties that we buy next to a very big anchor tenant. If you are interested, we can show you some of those properties, and those are usually very profitable. The other factor that you have to consider is tenant improvements. When you are the landlord and there is a new tenant coming in, you might have to give them some tenant improvement depending on what rate are you charging and what are they looking for. Sometimes the newer or smaller businesses, they don't have a lot of credit or financing available. So for that, there is usually what we recommend or what we do or some other landlords or investors do is that they do a percentage of rent. It's like a partnership with the tenants or with the businesses. So being a landlord, you can partner with the tenant, and whatever is the income that they get, they share a part of their ownership with that. We have a school that we were looking at, and we are going to partner with them depending on how long does it take and all that. The time frame is important, but that's one very good way of owning a part of the business and helping them with some rents. So it's like a partnership. The best thing about retail is like it can be triple net or double net. So for example, if you have a building and you have a tenant, then the tenant pays for the taxes, insurance, and the maintenance. If they pay for it, then as a landlord or as an investor or owner of the building, you don't have to worry about any taxes going up, the insurance going up, or you don't have to worry about maintaining the property. That's what we call it as sit on the butt investment. Every year the rents go up and they pay for all their utilities, of course, and the maintenance and the taxes and the insurance as well. So long term, and then the other advantage is there is long term lease as opposed to any any apartment complex or even the residential real estate. With the retail, you get like 3, 5, 10, 20, 30 years lease, and the increase in the rent is already signed in. Every year the rent goes up by a certain percentage, or every 3 years it goes up. So that way, and then the most important is if you have good national tenants, you can have the corporate guarantee. Like for example, you have a Subway as your tenant, then you can have a corporate guarantee from the Subway. So even if the local shop or the shop owner or the business owner goes out of business, Subway as a company or a corporate will pay you, and what they do is usually they replace that particular tenant or that particular franchisee with another person or another entity. So you don't lose any rent. They are liable to pay you for any downtime. So that is the biggest advantage. If you want to learn more about how to get the corporate guarantees or how to lease your commercial real estate properties with the national tenant, we can help you with that. If you have not started with any commercial real estate and want to get into commercial real estate, learn more about what are the different asset class, what is the best, what are the different trends, then reach out to us. We'll be glad to help you out. So those are two asset classes that are very popular. In the next video, we will get into the retail and the industrial sector and some warehouses and a hotel that is very popular as well. So I will see you after a couple of days or after some time. So see you. Bye bye. Thanks. Bye.